Hello viewers, we'll be going over gold futures. In this video, we'll be going over my trade idea of the week and how I developed that idea. So let's start off with the technical analysis. We're currently up 94 basis points on the 1-hour chart. We are nearing overbought RSI. We see a convergence on the 1-hour MACD, and we are resting along the 18 moving average, this purple line. As we expand out to the 4-hour chart, what we have here is we're still at overbought RSI, and we may see signs of the 4-hour MACD diverging. And if we expand out to the daily chart, what we have is an overbought RSI and no signs of the daily MACD diverging. And for the trade idea of the week, I'll be trading GLD. And for my trade idea, my position size will be less than 1% of my portfolio, and my entry will be $186.37, which is around this range right here, and fairly close to the 9-day moving average. And for my sell target for my long position is $193.64, and my stop loss for my long position is $184.13. On the other hand, if I were to make a short position, I would make an entry at $196.31, and my sell target will be $188.66. My stop loss for my short position will be $108.67. And how did I develop this trade idea? The range and bullish and bullish ratios come from the day-by-day probability model that comes from the model right here. So this is available in the link below. And as we progress to the 5th day or week of trading, we have a, say, 46% chance for gold futures to climb between 0 to 2.6%. And to the downside, we have a 46% chance for it to fall between 0 to negative 2.6%. And on the extreme case, we have an 8% chance for it to fall between negative 2.6% to negative 5.2%. So which one of these 13 models we should use as a reference? First, let's check the line graph. The blue line is our current trend, and the line overlapping it happens to be the best match. So right here we have our current trend, and the trend below is the one that we found on the line graph above. So let's compare both the trends. So on the current trend, we have 1, 2, 3, 4, 5, 6 points. And on the trend in question, we also have 1, 2, 3, 4, 5, 6 points. So there's reason to believe if the trends and patterns are somewhat the same, the outcome and forecast should be fairly same. So if we examine the forecast model for the trend that we just examined back then, or this trend, again, it dates back to July 8th to August 19, 2011. So if we head back to the forecast model, that is around right here. So we have 1 day out, that will be a Friday, and 2 days out will be a Monday, and so on. So we have 3 days out, 4 days out, and 5 days out. So the model that we just found and examined back then, gold futures fell around 1.6%. If we head back to the day-by-day probability model right here, that coincides with this standard deviation of 46% chance for gold futures to fall between 0 to negative 2.6%. If we examine closer on the technical performance of each trend, so we have the current trend right here, and on the trend that we just found and examined right here. So back then, it was 0% away from monthly high. Compare that to the current trend, which is 0% from monthly high. Back then, it was up 16% from monthly low. Compare that to current trend, up 13%. And back then, it was up 4% from 10 simple moving average. Compare that to current trend, which is up 4%. And back then, it was up 8.4% from 20-day simple moving average. Compare that to the current trend, which is up 7.8% from 20-day simple moving average. There are technical similarities among the two trends. We don't have the 50-day moving average because we're only examining a 30-day trend. Again, these models are available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.